Fintech capital has shifted away from aggressive customer acquisition. Since 2024, the market has pivoted toward reinforcing the structural foundations of the industry. Market activity has contracted sharply. Global fintech deal volume recently hit an 8-year low of just 4,719 transactions. This chart shows transaction volume decline overlaid with capital investment. While individual deals fell, total capital deployed climbed to $116 billion in 2025. This concentration signals investors prioritize scaled, mature platforms, navigating complex regulatory environments, over early-stage startups. The focus shifted from the consumer-facing neobanks of the early 2020s to the deep B2B backend rails. This transition marks a ground-up re-engineering of the global financial system's execution, settlement, and compliance architecture. Market dominance is currently being decided by the entities that build the underlying operational rails. This new stack relies on a departure from traditional predictive machine learning. For the last decade, AI in finance meant generating a static risk score for a human to review. Agentic AI completes a sequence of complex tasks autonomously. This workflow shows the difference. While the older node produces a score and stops, the agentic node moves data through multiple processing steps to execute an action. Deployment is already widespread. 43% of banks have moved past pilot programs to integrate these agents across internal functions, like fraud detection and compliance. These agents handle highly structured, high-volume tasks. They extract data from customer submissions, pre-screen loan documents, and flag anomalies in real time. A strict routing protocol ensures that autonomous systems handle the low-judgment processing and only escalate to a human when a task requires strategic oversight. Some institutions are now using deep learning models to process unstructured data, such as transaction patterns and news sentiment, to execute credit risk assessments with greater precision than traditional factors allow. In these environments, machines execute the workflows, while humans provide strategic supervision. The operational layer is bottlenecked by legacy settlement systems. Standard batch processing creates delays of up to 2 days before liquidity actually moves between institutions. This split-screen flow shows the transition to 24/7 liquidity. On the left, data blocks bottleneck at a timer. On the right, real-time payment networks and private stablecoins stream without interruption. Instant liquidity requires the ISO 2022 messaging standard to translate that data into an actionable format. This standard expands the data payload. Dense transactional context, such as invoice details and legal identifiers, travels concurrently with the funds. This rich data payload eliminates manual reconciliation, allowing for automated accounting the moment the funds arrive. ISO 2022 provides the architectural bridge that makes real-time liquidity institutionally viable and secure. Capital is being reallocated specifically to this layer. Investment in digital assets surged to $19.1 billion in 2025. This trend is being driven by the institutionalization of real-world asset tokenization. Traditional instruments, such as money market funds and government bonds, are being digitally represented as tokens on a blockchain. Tokenization enables fractional ownership, lowering the entry barriers for asset classes that previously required high minimums and complex custody. Operating on a unified ledger significantly reduces the intermediary custody layers, accelerating settlement times from days to seconds. Tokenization provides a structural mechanism to transform static, illiquid assets into programmable capital, operating independently of the retail cryptocurrency market. The current legal landscape acts as an engineering blueprint for open finance. The European Union's Financial Data Access Regulation, or FIDA, is currently the most aggressive forcing function in the global market. Under FIDA, institutions must provide immediate portability of customer data across all financial products, free of charge. Parallel mandates, like PSD3's requirement for real-time IBAN verification, are forcing a systemic upgrade of the underlying infrastructure. In the United States, the Genius Act established reserve requirements for payment stablecoin issuers, providing the regulatory certainty needed for institutional entry. These regulations mandate technical interoperability, forcing banks to re-architect their systems as open, API-driven networks. Instant settlement creates a severe systemic vulnerability. It removes the multi-day window traditionally used for manual fraud detection and intervention. In a real-time, interconnected network, A localized shock can trigger a cross-border default cascade in seconds. To manage this, institutions are adopting graph neural networks, or GNNs, to model risk. These networks map the financial system topologically, representing institutions as nodes and their bilateral liabilities as edges. This allows analysts to identify influential nodes and predict how contagion will spread through the network before a cascade occurs. In a system of instantaneous settlement, traditional linear models struggle to account for the speed and complexity of network-wide contagion. Protecting real-time infrastructure requires nonlinear, topological risk surveillance. This integrated stack combines Agentic AI at the base, real-time settlement and tokenized ledgers above it, bound by open finance APIs and a GNN risk mesh. Capital inflows reflect these priorities: $16.8 billion for AI, $19.2 billion for payments, and $19.1 billion for digital assets. The market has moved past the era of competing on front-end user interfaces. Financial institutions now operate within an interlocking system of instantaneous settlement and autonomous execution, functioning entirely without direct human intervention. Future market leaders are prioritizing high-performance engineering over traditional consumer interface design.